Most people think the next crisis will begin with stocks crashing. I don't. I think it begins in the bond market quietly while most eyes are somewhere else. When the safest market in the world starts choking, everything built on top of it starts to shake. That is the part people miss. They wait for panic on television, but by then the pressure is already moving through the whole system. If you care about the moments when history bends before the crowd notices, stay close to the way I'm thinking here, because this is one of those moments. I am not talking about some movie scene where the lights go out overnight. I am talking about the deeper kind of crisis, the kind that changes how money is priced, how wealth is stored, and how governments hold themselves together. Those shifts begin quietly. They begin when buyers start asking harder questions. The reason most people miss this is simple. Stocks are loud, Bitcoin is loud, politics is loud. The bond market is not loud until it is too late. It looks boring, technical, almost sleepy. But I've spent decades watching markets, and I can tell you this with complete calm. When the bond market changes character, the whole game changes with it. A bond is just a loan. When I buy a government bond, I am lending money to the government. The bond market is where those loans are issued and traded. If that market is healthy, money moves through the system at a price people can handle. If that market gets stressed, the cost of borrowing rises for governments, companies, homeowners, and almost everybody else. That is why I call it the backbone. People hear treasury bond and think safe. In one narrow sense, that is true. The US government can print money, so people assume it can always pay. But there is a big difference between getting paid back and keeping your purchasing power. Purchasing power means what your money can still buy after inflation eats away at it. If I lend for a long time and get paid back in weaker dollars, I may not have lost on paper, but I still lost in real life. That is why this matters now. The problem is not just that America has a lot of debt. The problem is that the debt is growing faster than the system's ability to carry it comfortably. I always look at debt in relation to income. For a country, income means the size of the economy and the tax base. If debt and debt service rise faster than income, pressure builds. It may not explode right away, but it does not go away. Right now, the numbers are not subtle. U.S. federal debt is around $36 trillion. In fiscal 2025, the government spent about $7.01 trillion and took in about $5.23 trillion. That left a deficit of roughly $1.78 trillion. A deficit is just the yearly gap between what comes in and what goes out. That gap has to be financed by issuing more debt, which means more bonds have to be sold into the market. That is where the hidden mechanism starts. Most people talk about debt like it is a static pile, something you can point at on a chart. I don't look at it that way. I look at the machine. I ask who has to borrow, who has to lend, at what price, and under what conditions. The bond market is not a museum. It is an auction. And if the supply of bonds keeps rising faster than demand, the price has to adjust. In bonds, when yields rise, prices fall. Yield is the return I get for lending money. If buyers want a higher return, the bond price has to drop to make that happen. That is why I pay attention when long-term yields climb, even when people are telling themselves everything is under control. In May of 2025, the 30-year Treasury yield briefly touched about 5.037%. That may sound small, but for a market this big, that move matters. It matters because the Treasury market is the reference point for almost everything else. When I say it is the risk-free rate, I mean it is the basic rate many other assets are built on. Mortgages lean on it. Corporate borrowing leans on it. Valuations in stocks lean on it. Private equity leans on it. Commercial real estate leans on it. So when Treasury yields rise for the wrong reason, the pressure does not stay in one corner. And I want you to sit with one question. If the asset most people call safe can lose a lot of value when yields rise, what does safe really mean in your own portfolio? If this kind of thinking helps you see risk before it gets a headline, keep following it closely, because this is where quiet losses begin. They do not begin with panic. They begin with wrong assumptions. Now, I want to go one layer deeper because this is where people usually stop thinking. They see higher debt and say, fine, but America has always had debt. That is true, but incomplete. A debt problem becomes a bond market problem when the new borrowing needed each year gets so large that the market starts asking for a much higher price to absorb it. In plain English, lenders stop being easy. They want more compensation, and they want it now. That is why I have said the deficit needs to move much closer to 3% of GDP. GDP is just the total value of the economy in a year. If the deficit is around 7% of GDP and I can bring it closer to 3%, the supply and demand imbalance in the bond market becomes much less dangerous. That is not ideology, it is arithmetic. When the hole is too big, financing the hole becomes the story. The Congressional Budget Office has projected deficits around $1.9 trillion and debt held by the public rising to about 118% of GDP by 2035. Debt held by the public means debt owned by investors, funds, banks, foreign governments, and others outside the federal government itself. That level is extremely high by historical standards, and the path matters as much as the level. When investors see a path that keeps worsening, they demand a higher return today, not later. Then there is interest expense, which is where this starts feeding on itself. Interest expense is the cost of carrying the debt already issued. The more debt I have and the higher the rate I pay, the more my interest bill grows. That means I borrow not just for spending, but increasingly to service past borrowing. In recent years, U.S. interest costs have surged so much that interest has become one of the government's largest expenses. When that happens, the debt machine starts eating its own future. I want to make this personal in the simplest way I can. If I earn $100,000 a year and my debt payments are manageable, I still have room to live, save, and invest. But if my debt payments keep rising faster than my income, sooner or later my choices narrow. I either spend less, earn more, refinance, or get into trouble. A country is more complex than a household, yes, but the pressure logic is not magic. Cash flow still rules in the end. The bond market is simply where that cash flow logic gets judged in real time. And the buyers matter. The buyers are not one single group. They include banks, pension funds, insurance companies, mutual funds, foreign central banks, sovereign wealth funds, hedge funds, and sometimes the Federal Reserve. Each of those buyers has a different motive. Some care about safety, some care about yield, some care about currency, some care about regulation. When their motives shift at the same time, the market feels it. Look at the demand side closely, and you can already see why I'm concerned. Foreign investors still hold a huge amount of treasuries, about $9.3 trillion by early 2026. Japan remains the largest foreign holder, around 1.2 trillion. China is much lower, under 700 billion, and its holdings have drifted down over time. That does not mean foreigners are dumping everything tomorrow morning. It means the old assumption that demand will always be there at comfortable prices is weaker than people think. The Federal Reserve is another part of this story. For years, it was a massive buyer through quantitative easing. Quantitative easing just means the central bank creates money and buys bonds to push rates down and support the system. But since 2022, the Fed has been shrinking its balance sheet and its securities holdings have fallen by more than $2.2 trillion. So one of the biggest price insensitive buyers is no longer absorbing supply the way it once did. That changes the balance in a very important way. If the Treasury must keep issuing a lot of bonds while the Fed is stepping back and some foreign demand is less reliable, private investors have to absorb more. Private investors are not charities. They demand price. They demand yield. They demand protection against inflation, against policy mistakes, and against currency weakness. That extra compensation is what shows up in the term premium. The term premium sounds technical, but it is easy to understand. It is the extra return investors demand for locking money away for a long time instead of rolling short-term debt. If I lend for 30 years, I want more protection because a lot can go wrong over 30 years. Inflation can surprise me, politics can surprise me, fiscal policy can surprise me. When that premium rises, it is often a signal that confidence is getting thinner. So ask yourself this: when you look at your own money, are you positioned for a world where refinancing stays calm, or for a world where the lender suddenly wants a much higher price? That is not a dramatic question. It is a practical one. If you want to keep learning how I frame these turning points, stay with this line of thought, because markets reprice long before most people emotionally accept what is happening. Now, some people will say, but if this were such a big problem, wouldn't stocks already be crashing? Not necessarily. Markets do not move in neat order. Sometimes stocks rise at the same time bonds fall, especially if people think nominal growth will stay high or money will get printed. Nominal growth means growth measured in current dollars, not adjusted for inflation. So I can see stocks hold up for a while even as the plumbing underneath starts sending a warning. I have said before that one sign of stress is when bonds go down while the dollar weakens and gold rises. That combination tells me some capital is looking for a way out of long duration paper promises. Long duration simply means assets tied to cash flows far in the future. If I no longer trust the long-term value of those promises, I start wanting either shorter claims, harder assets, or better compensation. That shift can happen before the average person feels any pain. And yes, we have already seen institutions react. Moody's downgraded the U.S. sovereign credit rating in May 2025, pointing to the country's growing debt burden and the lack of credible deficit reduction. That downgrade did not create the problem, but it reflected it. On the same day, the market focused sharply on fiscal worries. The 30-year yield touched that 5% area. Again, I am not saying a downgrade causes a collapse. I am saying it tells you how serious observers are reading the trajectory. I also watch market functioning, not just market level. In 2025, New York Fed analysis showed Treasury market liquidity worsened notably around the April tariff shock, with market depth falling to its weakest level since March 2023 before recovering later. Liquidity means how easily I can buy or sell without moving the price too much. If the deepest market in the world has moments where depth thins out fast, I pay attention. Stable systems do not need perfect calm, but fragile systems reveal themselves under stress. This is where the biggest skeptical objection usually comes in. People say, the United States issues the world's reserve currency, so none of this can become a real crisis. Reserve currency status is a massive advantage. I agree with that completely. It gives the U.S. more room, more time, and more flexibility than most countries could ever dream of having. But room is not the same as immunity. Time is not the same as solvency. Privilege can slow the math, but it cannot repeal it. If I can print the currency in which I owe the debt, I can usually avoid a classic default. That is the good news. The bad news is that avoiding default does not mean avoiding pain. I can pay people back in money that buys less. I can suppress rates for a while and punish savers. I can let inflation do part of the cleanup. I can lean on financial repression, which means guiding money into government debt through rules, incentives, and policy pressure. None of those outcomes feel like safety if I am the one holding the paper. This is why I say the bond market is the real crisis. The crisis is not just, will America miss a payment? I do not think that is the main issue. The crisis is whether the value of supposedly safe claims gets quietly diluted, whether interest costs crowd out other priorities, and whether policymakers get trapped into ugly choices. Those choices are never clean. Cut spending and growth slows. Raise taxes and politics explode. Print money and trust erodes. Borrow more and the market pushes back harder. The Bank for International Settlements warned in 2025 that governments had a narrow window to get their fiscal houses in order, and that higher debt with higher rates could lead to fiscal dominance. Fiscal dominance is when central banks start serving government financing needs more than price stability. In simple terms, the debt gets so big that money policy starts bending around it. If that happens, inflation can become harder to control and currencies can weaken sharply. That is not theory, that is a pattern. History gives me no comfort on this point. In the early 1990s, James Carville joked that if reincarnation were real, he wanted to come back as the bond market because it could intimidate everybody. He understood something many politicians still forget. Bond investors do not need elections to enforce discipline. They simply raise the price of money. And in 1994, a brutal bond sell-off reminded investors around the world that when yields jump fast, supposedly safe assets can inflict very real damage. I'm not saying today is a copy of 1994. History never repeats in a clean way, but it rhymes through incentives, through debt burdens, and through human behavior. When people get used to one regime, they build their balance sheets around it. Then the regime changes and they react too late. For years, people got used to low rates, strong bond support, and the idea that any stress would bring central bank relief. That conditioning is hard to unwind. It is even harder because politics makes honest solutions unpleasant. The clean answer is usually some mix of spending restraint, higher revenue, and better productivity growth. But every part of that hurts somebody in the short run. Politicians live in the short run. Markets do not. Markets will tolerate drift for a while, then suddenly they stop tolerating it. That is why I call it an inflection point. The pressure builds slowly, and then the feedback loops speed up. Here are the paths I can see from here. In the better path, Washington moves closer to a 3% deficit over time, growth stays decent, and the bond market settles down. Yields can stop climbing because supply pressure eases and confidence improves. In that world, I do not need a miracle. I just need credible arithmetic and enough political coordination to stop scaring lenders. That is the orderly path, and it is still possible. In the middle path, there is no real reform, but there is no immediate heart attack either. Deficits stay large, growth stays uneven, inflation runs hot enough to help the debt in nominal terms, and bondholders demand more yield from time to time. That world looks manageable on the surface, but it slowly transfers wealth from savers to debtors and from holders of fixed claims to holders of real assets. Many people will think everything is fine because nominal prices stay high. Quiet erosion is still erosion. In the hard path, the market reaches a point where long-term bonds need much higher yields to clear, liquidity thins out, and policymakers are forced to respond under pressure. Maybe that comes through a bad auction, maybe through a policy shock, maybe through foreign selling, maybe through inflation that proves sticky. Then the central bank faces a nasty choice: defend the market, defend the currency, or defend the economy. In reality, it tries to do all three and satisfies none of them perfectly. So what do I do with that as an investor? I do not make one heroic bet. I do not build a portfolio that only works if rates collapse or only works if inflation explodes. I try to balance. I respect cash flow. I respect diversification across different environments. I own some assets that do better with growth, some that hold up with inflation, some that are less exposed to long duration risk, and some hard assets that are not just somebody else's promise to pay. If I am an everyday saver, the practical lesson is simple. I would stop calling something safe just because it has the government's name on it and a long maturity. A long maturity means my money is locked up for a long time, and that makes me very sensitive to rising yields. I would pay attention to duration, inflation, and concentration. I would ask whether I am overexposed to one outcome, especially the outcome where the old low-rate world magically returns and stays forever. And I would watch the bond market the way a doctor watches blood pressure, not the way a tourist watches fireworks. I do not need drama to know something important is happening. I need pattern recognition. I need to see whether debt issuance is rising, whether buyers are demanding more compensation, whether interest expense is crowding out flexibility, and whether policymakers are dealing with the problem before the market forces them to. Those are not abstract signals. They are the vital signs. So let me leave you with one last question. Are you investing for the headline in front of you or for the system underneath it? If more people asked that question, they would stop being surprised by crises. And if you want to keep thinking at that level, the level of causes instead of noise, stay close to this work because these patterns repeat more than people think. I have seen enough cycles to know that markets do not usually break where the crowd is staring. They break where trust, math, and incentives quietly stop lining up. Right now, that pressure point is not some flashy corner of speculation. It is the market that sets the price of money for everything else. That is why I am watching bonds so closely. And that is why I believe the real crisis is the one still calm enough for most people to ignore. When the foundation starts to move, the walls may still look fine for a while. That delay fools people. It makes them think the warning was wrong. Then one day they realize the warning was early, not wrong. I would rather be early and prepared than comfortable and blind. In every debt cycle, that difference ends up costing people more than they expect. The bond market does not need to shout to change your life. It only needs to reprice the future.